Hello, everyone, and welcome to the latest episode in the D&O Diary Podcast series. Today, we're going to be talking about artificial intelligence, the hot topic in the business arena and in financial markets and in the world of D&O. And in this podcast today, we're going to be talking about everything. We're going to talk about litigation. We're going to talk about governance. We're going to talk about D&O underwriting. And hopefully we'll get to the point where we can talk about what artificial intelligence means for the D&O marketplace and the D&O arena. Sarah?
Yeah, well, thank you, Kevin, for previewing that this episode may be a little longer than some of our other episodes because artificial intelligence is no longer a technology issue. Boards, insurers, investors, and regulators are all grappling with AI risk. And so today, as you indicated, we're going to go through different types of artificial intelligence cases. Also, when we say AI, what does AI mean? As well as what types of underwriting and broker strategies can be deployed when we are thinking about how to underwrite D&O risk that's associated with artificial intelligence. So I think first, Kevin, you're going to go through some of the most early cases involving AI washing.
Yeah, since we're talking about the world of D&O, it's good to explore what claims have already been filed and talk about what they may tell us. And there have been enough claims that we can talk about the different kinds of claims within different categories. The most prominent one is the one that I think everyone might anticipate just intuitively. It's been called AI washing. AI washing is kind of an echo of something that we had dealt with a few years ago, which was greenwashing, which was the allegation that companies overstated their green or sustainability credentials. AI washing is essentially an allegation that defendant companies overstated their AI capabilities or their AI opportunities. I've got a couple of examples. One is regulatory and one is a private civil lawsuit. And the reason I wanted to mention the regulatory lawsuit is that it involves a private company. And I want to emphasize that because I think there might be a presumption that AI is a topic only of interest or concern to publicly traded companies. And that is not the case. The example I have involves a private company called Nate, and it had a business strategy where it was going to sell basically a business process that allowed internet-based businesses to allow their customers to avoid the shopping cart and the checkout process. It made it a one-step process. And it was achieving that strategy, it contended, by using AI, using artificial intelligence to complete those processes. Well, the allegation in the regulatory complaint the SEC filed against Nate and its founder, Albert Saniger, is that they were not, in fact, using AI to complete the processes, but instead they had a team of individuals working in the Philippines. And so it was not AI that was completing the process. It was old-fashioned human labor. And the allegation is that the company overstated that it was using AI and what AI was helping it do. An example of a private civil lawsuit is a company called AppLoving, which provides an ad-based platform for online gaming companies. They make their money by helping their customers get more ad exposures or more people downloading the app. And the company claimed that it was using an AI strategy to improve the likelihood that the gaming users would click on the ads or download the app, and that they were using AI to improve these results. But it turned out that instead, the allegation is the company was using old-fashioned manipulative techniques, the use of bots and so on, to increase the apparent click-through rate or the app download rate, and that artificial intelligence was not producing the allegedly improved numbers, but instead it was old-fashioned manipulative techniques. Again, the company overstated its AI, the effect AI was going to have on its business strategy and business outcomes. And that's one type of claim, and probably the most common type of claim so far.
Well, and it sounds like those are kind of the traditional securities fraud theories that are just being applied to AI disclosures. And I believe, that sounds a little bit like the ESG washing, right? The greenwashing that was going on a couple years ago.
I think it's fair, Sarah, to say that, that there's nothing novel about these lawsuits. They're in many ways sort of plain vanilla claims, a very familiar fact pattern allegations. The only difference is they happen to involve AI-related allegations. But there have been other kinds of AI claims, and I think it's worth talking about those other categories. And I'm going to go through the other categories briefly. The first one is a type of AI claim I've called AI risk disclosure claims. And this is by contrast to AI washing. In AI washing, the allegation is companies overstated their AI-related capabilities and opportunities. In an AI risk disclosure case, the allegation is that the defendant company understated the risk to the company from the adoption of AI. And I want to come back and talk about that risk category in a minute because it's worth drilling down on some more. But I'm going to first talk about the other categories. There have been what I would call AI infrastructure cases. These are companies that are not AI companies themselves, but they're providing sort of the plumbing and the pipes and the hardware that and the services and support that AI companies need. An example there is a company called Power Solutions, which is a energy solution provider that in 2025 announced it was going to adopt a AI-based strategy to provide power solutions to data centers. The company's share price declined when it later had to disclose that its rollout of its energy solutions to data centers was going more slowly than they'd anticipated. There were problems in the deployment, and the company's share price declined, and the securities class action lawsuit was filed. But the point is that it's not an AI company itself. It was simply providing good services support to AI companies. And because of the AI hype, its share price ramped up. And then when it experienced the setback, its share price declined. Two other categories quickly that I see. One is AI bubble cases where, there's so much investment being made in AI and companies are deploying such vast quantities of money that it creates the risk that, first of all, the companies will be forced to borrow more or raise more in the stock market, which could result in dilution of shareholder value. And there's actually an example of one of these cases. It's the software company Oracle, which at the end of 2025 announced that it had spent literally tens of billions of dollars more than originally projected on its AI strategy, and that it anticipated the level of spending to continue in 2026. And the company's share price declined not only because of the massive amount of debt the company was taking on, but also because by doing equity raises on the stock markets, it was diluting its shareholders' ownership interests and caused a decline in the share price. And just Friday, there was a very similar kind of lawsuit filed against Microsoft, very similar allegations concerning the amount that Microsoft is spending to execute on its AI-related strategy. The final category I want to talk about is AI follow-on litigation, where the company has been sued previously under another theory, and the advent of that lawsuit leads to a follow-on lawsuit against the company or its board. An example there is the document company Adobe, which was developing its own AI model, and it was hit with a prior intellectual property allegation by copyright holders alleging that Adobe had violated their copyrights in training their AI model. A D&O lawsuit filed. The allegation was against Adobe's board. The company had known that its model development was going to violate intellectual property rights of copyright holders. Yet the company went ahead with that strategy. The allegation is that the board breached their duties to the company and harmed the company's interests by taking steps that led to the intellectual property litigation. So there have been a variety of types of lawsuits. I want to circle back and talk about the risk-related category. And I have an example there, and it's one that's worth thinking about because I think it points to some of the difficult areas of risk exposure that the rollout of AI is creating. The example I have involves the community bulletin board company Reddit, where members of the community can post questions on the site and other members of the community answer the questions. Reddit's business model is based on advertisement, and the more people to see the ads on its community bulletin board, the more revenue it gets. The way it gets people to look at the bulletin board and produce the ad click-throughs that produce the revenue is that a member of the community might go to Google and type in a question, And Google, in response to the query, would give them a link to the site on the community bulletin board that answered the question. Well, most of the listeners know that in its adoption of its own AI strategy, Google has changed the way it responds to queries. It no longer gives you the list of blue links, but instead it gives you an AI-generated paragraph that actually answers the question. And if the person who typed the question in gets the answer to the question from Google, they don't need to go through to Reddit to see the answer on Reddit. And Reddit saw its volume of users declining, which meant that its share price declined as a result of a decline in revenue. I think it's an example worth thinking about because in this case, it wasn't Reddit's adoption of AI that caused its problems. It was Google's adoption. It was a third party's execution of its own AI strategy that caused the problems for Reddit. And I think that's important because basically every enterprise out there is going to have members of its circle of relationship adopting AI, customers, suppliers, vendors, regulators, third-party bad actors are going to be interacting with their company or changing the business environment as a result of those third parties' adoption of AI. And I think that underscores what a challenge AI is from a business operational standpoint. And it also creates a risk for the boards of companies to anticipate and manage the risk, and for D&O insurance underwriters to understand what the risk exposures are for companies and what problems they may face. And I think it's worth emphasizing this point about the risk exposures. I think if we come back in 5 years' time, Sarah, and talk about the litigation that's been filed, this area is going to turn out to be the one that was the most serious. And I think it highlights the problems for corporate management, corporate boards of not only deploying their own AI strategy, but negotiating their way through a world in which AI is increasingly ubiquitous.
Yeah, I think that's right, Kevin. I think that that's a signal, even as we've seen kind of the evolution of litigation, the examples that you gave with respect to AI washing, those were from, March, April of 2025. And then we're seeing these more recent cases that are against companies, and they've become securities cases that tie into either a company that may have some sort of relationship with artificial intelligence, whether or not it's integration themselves or a business model that's reliant on artificial intelligence. I think, Power Solutions International to me raised those thoughts about the data centers, right? So if you have a data center strategy, but you're not anticipating a municipality voting against a data center going in, that could be impactful. And that is certainly an external factor. Also, with respect to the Reddit case, I'm also thinking about, yes, there's reliant on kind of, especially in Reddit, another party. And then if they use AI and that impacts your business. But what about competitors? A lot of this froth about artificial intelligence is coming in because it's a competitive environment. And if you feel like there are, other parties that are using artificial intelligence and they're getting ahead and their businesses are growing, it's hard not to have that pressure on leadership and a board to have an AI forward strategy, perhaps even faster than some of the risk exposures that we.
Well, I completely agree. And I think we do need to talk about board governance, but I think there's an intellectually prior point that I think we need to cover. And that's that we tend to talk about AI like it's one thing, like AI is one specific concrete thing. But in fact, when you refer to artificial intelligence generally, you could be talking about any one of a number of things, which is another factor that contributes to the risk environment and the challenge for boards and for D&O underwriters. So,
Yeah.
I think it's important to clarify when we're talking about AI what we mean and what AI encompasses.
Well, yeah, sure. And I think three of the types of artificial intelligence that we've seen come up in private cases and then also securities litigation involve, predictive artificial intelligence. So that is when you're using, an artificial intelligent model, a large language learning model, and really, or even just an algorithm, and you're trying to use predictions to determine an outcome, right? So We saw this kind of in the Workday case where for employment decisions, and there have been allegations against other types of recruiting software that, there's inherent bias in collecting data about a certain type of worker, a certain age cohort, and then to allow for resumes to come through. There have been problems when predictive AI is trying to identify, hey, this type of outcome is going to happen. And especially when it involves people, that inherent bias that's part of what the artificial intelligence has learned from could be problematic, especially if there's already prior known indicators that that type of predictive modeling can lead to bias. That's oftentimes, if we've seen, where a wrongful employment practice can eventually lead to a D&O claim against a board that knew or should have known that particular model could have an outcome that was illegal. Similarly, with generative artificial intelligence, I think that's the one that most people associate with AI. That's where, we've seen kind of those intellectual property concerns, because that's the garbage in, garbage out. When I think about the lawsuits that have been brought by the New York Times, by publishers, by authors against certain artificial intelligence companies, that AI that's related to IP could also be a problem for DAs and Os, especially depending on how these cases come down the pike. If they're settled or eventually go to trial, if a company knew or should have known that there would be IP concerns, that would be problematic. Also, generative AI has been associated with hallucinations. And so, if again, a company has an artificial intelligence strategy, but without kind of a requirement or a best practice to review an outcome, a hallucination could be really problematic to a company. And then there's agentic AI. So, agentic AI is that autonomous artificial intelligence decision making. That's kind of the most recent types of models that we're seeing come out, where you could have a AI little GPT running in the background, collecting data, kind of doing the work for you, right? Without human oversight. That's where you're going to have potential control failure concerns. And so I think, thinking about, and just those are three of kind of the main examples where we're already seeing either regulatory concern regarding the artificial intelligence or litigation that has occurred as a result of the utility of that artificial intelligence. It's important to kind of at least recognize there are different types of AI. And going back to how do we underwrite or how do we broker to the risk, having awareness about these types of artificial intelligence may help also assess the risk and then eventually determine how to hold the risk.
I think that differentiating among the types of AI risk is also crucial for corporate boards. And, you've mentioned a couple of times the challenges for boards of governance over AI. And I think everybody recognized that in some ways it's a new world with AI and that past models, past approaches may no longer be adequate. But I wonder if therefore that means that we need new governance frameworks. Or is it the case that existing governance frameworks just need to be customized to address this emerging area of operations and risk exposure? My own view is that the tools that exist are adequate. They just need to be customized to reflect the challenges that AI creates.
Yeah, and I think with respect to kind of when you think about that governance framework, it's also making sure that, complying with having a finger on the pulse of the changing regulatory landscape. We know that the EU already has addressed artificial intelligence similarly to them being ahead on kind of the privacy acts before. But then in the United States, we're seeing a much more fragmented state approach with respect to addressing how artificial intelligence should be overseen by the state, and especially when there is a B2C, meaning where one of these companies may have a product that affects the constituents of a particular state, addressing the, impact to bodily injury or harm that could be caused by artificial intelligence. We've seen kind of state attorney generals try to come after companies where they feel like a constituent may be harmed by artificial intelligence. So I think kind of having those processes in place, but also having a recognition that there's a shifting regulatory landscape. And for right now in the United States, that it's fragmented is
It,
important as well.
it's not only shifting, it's uncertain. I mean,
Yes.
pretty much every state has either adopted some type of AI legislation or is considering it. And there's a brewing federalism issue as the White House would like federal law to control and preempt state legislation. So we've got not only patchwork regulation, but potentially inconsistent regulation. And unfortunately, for many companies, that means you have to default to the most restrictive, whatever state's law is the most restrictive, just from a protective standpoint, to default to that, the most restrictive legal framework. Creating the framework and tools to negotiate the regulatory environment is one of many challenges for corporate boards. And just one point I want to make is that I think it's only a matter of time till we get an AI-related breach of the duty of oversight. That, the developing case law, particularly in Delaware, about the duties of boards to monitor mission-critical operations within their companies or to respond to red flags about operations of the company. I think you can kind of set a clock on it, that there will be a claim in some time interval that raises those allegations. And I think that puts a burden on boards to ensure that they have processes in place so that you can never guarantee that there aren't going to be problems. But if there are problems, you can show that the board took reasonable steps to try and monitor the development of this rapidly evolving area and that they document those processes. And I think that's probably the key for developing corporate governance area, is having processes calculated to address these areas and document the processes. And, talking about all that, I think underscores the problem for D&O insurance underwriters and the challenges they face in trying to determine whether to accept a risk, how to price it, on what terms and conditions. And that is a challenging environment for the D&O underwriters.
Yeah, and we've already seen that there have been underwriters that have filed with certain states exclusions that address artificial intelligence, and they may be exclusions that could be attached to cyber, tech, E&O, but surely we may see artificial intelligence related exclusions that could apply to D&O as well if underwriters decide they don't want to hold that risk.
I'm sorry to interrupt, but in the current soft market, I'm skeptical that any carrier that wants to stay in the game is going to be able to add exclusions. But I think that if the market should start to turn to the next phase of the cycle, I think we should anticipate that maybe for some areas, maybe for some types of companies, maybe for some types of business strategies, maybe for certain industries, there could be exclusions, which definitely could create a risk transfer problem for companies seeking to use insurance as part of their overall risk management strategy.
Well, perhaps it's the claims that we've already seen that could be creating kind of that shift in the approach and consideration about whether or not to hold the risk, because artificial intelligence itself is accelerating at such a quick pace, its utility and integration that, so many companies are beginning. Whether or not there is a governance strategy in place, I think will become extremely important with respect to attempting to underwrite the risk.
That's true. And I think just given the nature of the D&O marketplace itself, what's going to be increasingly important, especially if we get to the point where carriers are starting to try and put exclusions, it's going to be important for those who counsel companies on their D&O insurance to be aware of what the different carrier strategies are. The different carriers are going to have different risk appetites. They're going to segment the risk differently. They're going to price the risk differently. And that's actually one of the beauties of the D&O marketplace, is that the carriers do take a diversity of approaches. And that's critical for folks like us, Sarah, that have to help companies find solutions, that the carriers do take different approaches. I'm hopeful that there's enough diversity of approach to the process of placing D&O insurance that there will continue to be solutions available for different types of risk, even if they're not the same solutions from the same carriers throughout the marketplace.
That's right. And I think, there's things that we need to remember, as we try to help place coverage where we know artificial intelligence is being incorporated, is being used, or there's just extreme pressure for clients to have artificial intelligence integrated into their business strategies. And so, craft underwriting, to your point, Kevin, has always existed in D&O. So, thinking about how different sectors are impacted by artificial intelligence, where the pressures are the most acute. I think similarly, we think about this with antitrust. Are there places that may have more scrutiny over, anti-competitive practices? Similarly with artificial intelligence, is it a business that faces consumers that, is using artificial intelligence to communicate with constituents? Perhaps there's more regulatory scrutiny there. Similarly, also, if a business itself has indicated that artificial intelligence is integral to its actual ability to drive revenue, how that is being communicated to the marketplace could be important as well. So I think there's lots of opportunities to be creative and thoughtful about how to appropriately place risk where artificial intelligence is just permeating throughout. It seems like every company now.
The one thing I can say with confidence is that this is going to continue to evolve. My crystal ball is no better than anybody else's, but I expect this is a topic we will be talking about for months and years to come. It's been great talking to you today, Sarah. I enjoyed it. We probably only scratched the surface, but it was great to talk about what's happening now with artificial intelligence. And I look forward to our next podcast in the D&O Diary Podcast series.
Looking forward to it. Thank you, everyone, for joining us.
Thank you all.